Everyone. Even though my tax affairs are completely in order and I'm cleaner than clean, that still makes me incredibly nervous. Right. Global listed infrastructure. This is an asset class. It's an asset class that has very recently proven itself in an exceptional way, I think. And I would love to take you through this asset class and the strategy that we undertake to express it. So there are some learning outcomes. We're going to explain the characteristics of listed infrastructure, the scope of our strategy, and demonstrate some of the benefits, characteristics the asset class provides to clients. There is actually also a bonus outcome, a bonus learning outcome. Are there any Americans in the room before I make fun of you? Yes? Okay. Just a little bit of fun of you. I'm actually not American, despite my accent. I'll water this down a little bit then. By the end of this session, you will know something about America that 99.9% of Americans don't. Now, that might not be a very high bar to get over, but this one's kind of fun, actually. And the way we're going to get there is through a little bit of a journey through history. And bizarrely, I mean, by some sort of planetary alignment and constellational coincidence, this is coinciding perfectly with my son's GCSE history mock, and he hates history and he doesn't understand why I enjoy it so much, but please think of him because he can really use your support. We are going on a little journey into the past. We will then come into the present, and this is all with regards to infrastructure, of course, and then with a look to what I think is a very exciting future for this asset class. Right, so let's start with history. This wonderful lithograph dating back to the 18th century, depicts the Great North Road, which was one of the very important passageways into London. It's seen here approaching Highgate, which was the last stop before Smithfield Market, not too far away from here. And as idyllic as it looks, don't worry, I am going somewhere with this. There are some serious issues with this bit of road. One is probably quite obvious, and that is the ruts in the road caused by the rather wet weather that we have in this country. And then, of course, when you come upon ruts and mud with your carriage, the easy way to avoid that is you just go around it, and then the next person goes around that, and you start to encroach on people's land, and it's all very chaotic. And the importance of roads around this time was very, very high because, of course, the United Kingdom was industrializing. There were all kind of need. There was no sort of coordinated system or national approach to any of this. And in the words of King George, it was madness. Thank you. But there was a very creative solution, and this is where we get into learning outcome bonus. Has anybody driven in the United States of America, mainly on the eastern seaboard, on something called a turnpike? Yeah, turnpike? Does our American friend know the origin of the word turnpike? Great. Okay, so you will help that 0.1% of your fellow countrymen. Turnpike. Well, here's some etymology. It actually, it's a term that originates here. This is Middle English. And the word pike is the Old English version of what we would call a spike. And if you take a number of spikes, sharpened wooden spikes, and you lash them together to make a gate, you can put that gate at the entrance to a roadway, and you can force somebody to pay a toll. And if they pay the toll, then you'll turn the pike. So that's the turnpike. So it's a term that's still used in America, not so much here. And it was a wonderful invention because it gave rise to a series of turnpike trusts. There's an example of one, King George II, 1738. And these trusts were created for the benefit of society. The trust would administer sections of road and would receive the tolls paid by the travelers to pass along those roads, and would use 100% of the proceeds of those tolls to better the roads, to widen them, to extend them, to create new roads. And so it was typically actually administered by parishes. So this was all a very charitable set of outcomes, and it improved the system of roads in the UK immensely during a period which was very much in need. And that history lives on in parts of London. This is actually not far from the terminus of the Great North Road, the Turnpike Lane tube station. So some really interesting history. This was the first known set of toll roads in existence, so an infrastructure asset. But then the Americans came along, sorry again, and like so many other occasions, took a great British idea and figured out a way to make real money out of it. And which brings us to what we think, having done a lot of research on this, is America's first non-financial listed equity company. It's amazing. This is even before the New York Stock Exchange. This was actually the Philadelphia Stock Exchange, which predates the New York Stock Exchange by a few years. The Philadelphia and Lancaster Turnpike Road. There is a share certificate. You can probably just about make out the date, 1795. This was a toll road enterprise that was created in America to earn a return on behalf of the equity investors in the toll road. The signature on this certificate is none other than an individual called William Bingham, and you couldn't make this stuff up. William Bingham was an American-born privateer. He was an enemy of the British Empire, having captured ships in the Caribbean and using their armaments in the War of Independence to beat the British. He created this company, became extremely wealthy, didn't pay any tax. Where's our tax advisor? And then somehow managed to marry his daughters into the British aristocracy, move to Somerset, retire a wonderful, wealthy life, and is buried there. There's probably a Brexit joke in there somewhere, but I am going to put that aside. In any case, they built this wonderful road in Pennsylvania. Quite an idyllic image there. And the other thing they borrowed from the British in building this road is that they built taverns along the way. 22 taverns in 23 miles of toll road. The last mile was controlled by the Quakers, and they just wouldn't have it. So that was an interesting outcome, and they were actually big investors in this toll road. That's what it looks like today. You can just about make out Turnpike there, Pennsylvania Turnpike. It's a huge network of toll roads in Pennsylvania. I'm a little bit obsessive about these things. I go there, I take pictures of toll roads. There's Florida, there's New Jersey, and Pennsylvania, of course. But in any case, this was an incredibly profitable endeavor. $300,000 of IPO proceeds, a lot of money back then in 1792. Once it was built, it was generating 5.5% dividend yield for Mr. Bingham and his fellow equity holders. That network of toll roads has, of course, expanded. It includes the original bits of road, generating $1.2 billion of revenue in 2018 for the state of Pennsylvania. I do all of this, I talk to you all about this because I really want to highlight the enduring long-term nature of this asset class. This isn't the only example. Consolidated Edison is actually America's oldest surviving listed infrastructure company. It's in fact the longest standing member of the New York Stock Exchange, with the longest list in history. Started in 1884 providing gas to lamps in New York City. Used to be called Consolidated Gas, and they have a long history of wonderful dividend growth and share price appreciation, and I will get into this. This is the exciting bit about this asset class. Continues to survive today. Here you can see them installing solar panels along the Hudson River. So again, an enduring, long life asset class with a wonderful history. And what we're really aiming to access here with this asset class is long life, consistent, reliable cash flow streams over time that grow. And that's a very important element. Now, that brings us to the present. Sorry about the little history lesson. The present is not without its challenges. We, in this country, in many countries, face significant congestion on our toll roads, congestion in public transit. This is an image from Asia, but it could well be Waterloo Station at 5 o'clock on a Wednesday. And then, of course, airport congestion. And sad to say, the state of developed market infrastructure is quite poor. And the reason for that is governments aren't spending money like they used to. In the post-war period in the US, 5% of GDP was spent on infrastructure. That's fallen to less than 1.5%, and this is despite all the arm-waving by politicians with orange hair, orange skin, and otherwise. And this gives rise to a huge opportunity because it falls upon the private sector and opportunities in listed infrastructure specifically to access the opportunity to invest in infrastructure, to improve, to create, and earn a return. And things are so bad that the every 3-year report card from the U.S. Society of Civil Engineers gives the U.S. a pretty dismal failing grade in most categories of infrastructure. It's only slightly better than my son's report card, but overall, the score for U.S. infrastructure, the capital of the free world, is a pretty dismal D+. And that gives us huge opportunity. In fact, many of the businesses that we are invested in are investing themselves in significant infrastructure projects, typically in toll roads, incidentally, and in other areas, and earning an outsized return on the investment because of the drastic need. The infrastructure requirements are not restricted to just North America or even developed markets for that matter. Because of fast-growing economies, populations, and so on, nearly 2/3 of the infrastructure investment opportunity is actually in emerging markets, China and otherwise. So having a global approach to the asset class is very, very important. And for that reason, we are able to invest in opportunities in all parts of the globe. Now, if we think to the future and what infrastructure can potentially bring in the way of opportunity, we start thinking about some quite thematic and important tailwinds that are affecting economies and society, one of which is, of course, renewable energy, the transportation of the future. Please don't talk to me about electric vehicles without talking to me about the need for grid infrastructure hardening and improvements to low-voltage networks, making them smart, making them bimodal and bidirectional, and then, of course, charging stations. Because if 4 or 5 of us living in the same block decide we'd love to have an electric vehicle and charge it at home, we all plug them in at around the same time when we get home from work, we've blown the local substation, and it'll take a few days for them to get power back. Urbanization is another important trend. 80% of children in the world today are born in cities. It is an important demographic trend that is giving rise to significant infrastructure requirements and opportunities, public transit, roadways, and so on. Universal connectivity, we have a component of our strategy which is digital infrastructure, and that is a very important element to connecting more and more people, particularly in emerging markets, to networks. Water and waste management, increasingly an important area of need and opportunity for infrastructure investment. And finally, again, these social and demographic shifts that are giving rise in part to social infrastructure requirements, particularly older age infrastructure and health infrastructure needs. So there's a lot of exciting stuff to come for this asset class. Now, if you will forgive us a little bit of a commercial break, we will highlight the strategy that we run, the benefit of that strategy, and how we think about the asset class. So I keep calling it an asset class, even though we are invested strictly in listed equities with 100% liquidity, by the way. I always like to add that in. So it is equity, but it's the equity that behaves differently from the broader equity market. And what we ultimately achieve, and this is real, these are real numbers, this is our investable universe of listed infrastructure businesses that must meet our very strict criteria, is an enhanced return to global equities, certainly fixed income, especially now, with lower volatility than the broader equity market. So it is really a sweet spot. We feel that this is very much an appropriate allocation within a multi-asset client portfolio, and I think you'll agree with me once you see some of the characteristics that the asset class provides. One of which, very importantly, is an enhanced income stream. So premium dividend yield to the broader market. Now, we don't go out there and target dividend yield. I think that's a very dangerous game because it would be very easy for us to go and find 5 and 6% yielding listed infrastructure businesses and say, here you go, here's a high yield strategy. But all we'd really be doing in a scenario like that is offering you up a bond proxy, and that's not what we do. We look for growth in the underlying dividend stream. Now, that said, we do deliver that premium dividend yield. Currently, it's more than 100 basis points over the broader equity market, sitting at around 3.5%. And it's very consistent because the businesses we invest in are very reliable revenue generators, cash flow generators, they pay their dividends, and critically for us, they grow their dividends. It's very important, which brings us to the second objective, the first being the premium dividend yield, the second being to deliver a growing distribution stream to our unit holders year after year in sterling terms. That is objective number 2. The third objective is to deliver all of that with lower volatility and drawdown in the broader market. And you'll see that the beta on the strategy is significantly less than 1, typically gravitates between 0.6 and 0.8. And then the drawdown characteristics I'd like to dwell on for a quick moment. Yes, this is listed equity. Yes, in a global financial crisis, everything tends to correlate very highly and equities will of any sort will get caught up in a sell-off. But it's hard to see from that chart, but there is downside protection. Hate to have to come to you and say, oh, good news, we only lost 40% at the low, whereas the broader market lost 60. But it is downside protection. Obviously, that's an extreme event. But I think what's far more important is the speed with which these businesses recover their equity values after a crisis. Whereas the broader market took years post the global financial crisis, these kinds of businesses rebound very quickly. Why should that be? Well, they continue to earn revenues. I don't know if many of you turned your gas or electric or your water off during the global financial crisis. I didn't. The revenue generation is quite consistent. Cash flow generation equally so. And then, of course, dividend and dividend growth. And the market can't ignore that for very long and tends to re-rate these businesses very quickly. So that is what we focus on, is the growing dividend stream. We are long-term investors. We are low turnover. We have very much an asset ownership mentality when it comes to this sector, with a view to accessing very long-term cash flow streams. And as the first investor in the fund, with my cashed-in DB pension by way of my SIP, I am very keen to access these cash flows when I retire and face long-term liabilities at the time, rather than the fixed cash flows that might seem attractive at the moment because they're generating a high yield, but we'd much rather accept a lower starting yield and access the growth in the dividend stream. And ultimately, that finds its way into equity values and the appreciation of capital. So what do we invest in? Well, it's very important when investing in infrastructure strategies to really understand what you're investing in. There are a number of strategies out there. They're all quite different. I actually think many of them are quite complementary. But it's very important, I think, to highlight how we think about infrastructure and what we invest in. For us, it's got to be critical infrastructure of one form or another. Long life concessions are very important to us. The longer the life of the asset, the better, because you tend to get a lot of optionality arising over time. And then finally, the ultimate long life investment, perpetual royalties, which can actually take us back to the 17th century. One of our holdings actually can trace its asset base back to the year 1667, when it was created by edict by King Charles II. Sorry, I'm slipping back into a little history lesson, but still generating cash flows today. So these are cash flow streams tied to physical assets that never expire. So the physical asset is the common denominator for us. We don't invest in things like cement companies, steel companies, engineering firms, contracting firms like Carillion or Interserve. Uninvestable for us because they don't own and control the physical asset. And that's really important because that's what ultimately assures you of the longevity of cash flow streams, the reliability and consistency of cash flows well into the future. Because if you've got a physical footprint, you've typically got a barrier to entry, a strategic advantage, and no one can compete those returns away typically, especially when you've got a monopoly or an oligopoly position. So that's why we think about physical assets and long lives. And just turning to the areas in which we invest. We split the listed infrastructure asset class into 3 distinct categories. The first will be very familiar to all of you. I think this is what you would typically associate with the term infrastructure: utility businesses that we rely upon day to day, energy infrastructure, transportation infrastructure, the typical economic infrastructure, sometimes called core. And the dividend profile that we tend to get from these types of businesses, remembering that we're always looking for growth in the underlying cash flow stream. And yes, folks, utility businesses can grow. And I can happily give you some examples of that. We get a generous dividend yield to start, and we get GDP plus type growth in the dividend stream from this category of infrastructure. It's typically between 65-75% of our overall exposure. Obviously very important, core to our strategy. The second category is actually quite different, very defensive in nature: social infrastructure, consisting of health, education, and civic infrastructure assets. Defensive because typically if you own and control one of these infrastructure assets, let's say a magistrate's court, for example, you earn a revenue contractually regardless of whether it's used or not. So it's availability based, and typically the revenue stream is linked to inflation. So it won't surprise you that the traditional dividend growth profile for this category of infrastructure is a more generous starting yield and inflation rate type of growth. So not overly exciting, but very reliable and actually quite defensive. It's an area that's come in very handy in difficult markets over the last couple of years. And health infrastructure addresses some of those demographic trends that I was highlighting, remembering that we're investing in the actual facilities themselves, not the services that go on inside of them. So it's actually the physical infrastructure we're invested in. And then when we get very excited, and this is where the future really starts to come into play, is in the evolving category of infrastructure, which is experiencing, and we expect to continue to experience, structural growth. So what we get here is typically a lower starting yield, which is fully acceptable when you're growing that dividend stream at high teens rates of growth. And we get that through typically communications infrastructure, towers, data centers, optical networks. This is simply acknowledging that we are living in a rapidly changing society, economy, increasingly digital, increasingly virtual. And as much as it's a virtual economy, it relies upon real physical infrastructure to make it possible. Any millennials in the room, without data centers, there is no Tinder. Without mobile phone towers, there is no mobile phone signal to access your Tinder. I don't know anything about this stuff, by the way. Optical networks, of course, to deliver increasing requirements around broadband and data. Transactional infrastructure, not much different. Physical infrastructure assets that are owned by the payment infrastructure businesses that ensure a increasingly cashless society continues to operate. And then finally, those perpetual royalties that I highlighted earlier, which are great inflation hedges as well, by the way, with cash flow streams that never expire. So those are the 3 categories across which we invest. We diversify the nature of dividend growth by investing across the 3. We diversify across the various sectors, across the various subsectors, and then being a global strategy, of course, we are also diversifying regionally. And that approach has come in extremely handy for us over the last little while. And we'd be happy to take you through our experience so far with the strategy. We've been working on this for 5 years or so, and after running a model portfolio for a couple of years, we launched officially as an open-ended OIC here in the UK in the latter half of 2017. So we don't have the full performance for 17, but we do have the full year 18, which demonstrates the defensive characteristics of the asset class in what turned out to be a bit of a difficult market. We managed to preserve the capital. But we're not just a defensive strategy. Because we are seeking to access growth, we also get to participate in upside when it arises. And so year-to-date 2019, and this is a bit unusual, I will acknowledge, we are certainly delivering versus the broader market. And I will break that down a little bit for you and show you where that comes from. If we take a few of the episodes over the first couple of years of the fund's existence, you'll see in the early part of last year we had similar concerns around economic growth as we are currently or have been currently experiencing. And the broader market came under some pressure at that time. And we were able to provide some downside protection. Interestingly, primarily owing to the evolving infrastructure exposure in the fund. So in other words, businesses that are more structural in nature and less dependent on economic cycles. Then everything appeared to be just fine. The market rebounded, and the economy seemed to be in good shape. And we were able to participate to the upside, again, interestingly, owing to the economic exposure in the portfolio. So a different set of contributors during that episode in the middle part of last year. And then we came to that very difficult period in Q4 where the broader market took a proper thumping, and we were able to protect the downside with a diversified set of contributors across the three categories of infrastructure. 2019 rolls around, the market rebounds. Again, we're able to keep up with a diversified set of contributions. And then the old adage of sell in May and go away should probably be changed to sell on the 30th of April, because that was actually the top of the market. And in May, we had quite an unusual set of outcomes. Can't imagine this will happen very often, but the market coming under some pressure, and we were able to actually add. We are a stock picking portfolio. We are bottom up. We are concentrated. We only hold between 40 and 50 companies in the portfolio, so we're very careful about what we own, and so obviously stock selection is important here. But throughout all of this, we actually weren't changing much. People ask me, did you tactically go to cash? Did you wait? We weren't doing anything. This is really the asset class demonstrating the characteristics that I highlighted earlier. In terms of volatility, we've managed to keep the volatility lower than the broader market. The beta has actually fallen over time, interestingly, so providing the diversification benefits in a multi-asset portfolio. We can't really control what the market does, but we can certainly measure ourselves by way of the dividend growth that we receive from the businesses we invest in. And we've highlighted a few selected dividend growth experiences in the fund in the first couple of years of existence. And I actually like to highlight the leftmost panel because it really does illustrate that utility businesses can grow. Enel, because of renewable energy, because of electric vehicle deployments, because of its exposure in Latin America in terms of its growth investments. Naturgy, because of its natural gas exposure as a transition fuel, LNG, and so on. And Ørsted, with a wonderful 50% dividend increase last year, being the largest player in the world in offshore wind, with most of its exposure right here in the UK, on both coasts. So that is an exciting story with undergoing structural growth. Similar types of dividend growth in transportation and energy infrastructure, and then that evolving category of infrastructure, once again giving us that outsized dividend growth from that component of the strategy. So I will summarize. I'm told there might be questions or a panel afterwards, just by highlighting once again the enduring nature of the asset class, its consistency, its inflation-beating cash flows by way of the growth in the underlying businesses or links to inflation in the contracts. The defensive qualities and low volatility, I think, are extremely important. They've demonstrated their importance of late. And really, I do feel we have quite a positive and exciting future for this asset class by way of a lot of those structural driving thematic and trends that are behind a lot of the changes in the way we live and the infrastructure we need to do so. So I will end it there. Damien, I'm not sure if we have a panel or questions or anything like that. I can't pretend to answer any questions on tax policy.
I do have some questions for you if you'd
yeah.
like to go through those.
Okay. Trump, right. Look at my American friend again. Sorry, no, I shouldn't do that. We don't trust politicians, generally speaking. There was a lot of arm waving around infrastructure in the United States during the election campaign and thereafter. And it's actually one of the few things that the Democrats and the Republicans agree upon. The problem in America is it is very difficult to federally coordinate, choreograph infrastructure build because infrastructure by its nature is actually under the jurisdiction of the state. So there can be tax incentives and various forms of policy that can be put in place, but ultimately the state has to decide. And so it's very difficult. Permitting is difficult. I would not invest in a business on the premise of political promises for infrastructure spend. So what we're invested in are businesses that are actually privately building and benefiting from infrastructure in America, such as businesses building toll roads and operating toll roads in Texas, in Virginia. We're invested in those businesses. One of our businesses has been buying airports in the United States because the federal construct cannot fund these kinds of spends. So it does fall upon the private sector. So we don't trust the politicians and all their arm waving. Typical allocation. Typical allocation. Within our multi-asset team, it's between 5 and 10%. I don't know how they arrive at those numbers. I'm not the expert in that area because I think a lot of the work that's done to make those decisions is built around correlations and how it all fits in to a specific client's risk needs. But what we have mainly seen is between 5 and 10%. And interestingly, in our travels around the country, we are finding more and more clients that actually have not just an allocation specifically to listed infrastructure, but multiple strategies within that. I mentioned earlier there are other strategies. They can be complementary. Some are high yield, some are emerging markets, some are regional, some are global. And we have come across clients that have, say, a 10% allocation to the asset class and 3 or 4 different strategies inside that. And that, I mean, that for me is like angels singing. I just love that. So I do think that it is an emerging and increasingly adopted asset class. Right, from Donald Trump to Jeremy Corbyn. Yes, nationalization. Well, interestingly, when you invest in, let's say, critical infrastructure like utility businesses, you will typically face regulatory oversight of some form or another. Sometimes it's very comprehensive, other times it's light touch. And it won't surprise you that regulatory environments and ideologies are not all created equal around the world. So having lived here for 17 years, I am actually now British, as well as being Canadian, by the way. I was very subtle in saying I wasn't American. I happen to be Canadian. I still don't understand this constant acrimony between the allegedly independent regulators and operating companies. I spend a lot of time with Ofgem, a lot of time with Ofwat. I've gone into number 10 to talk energy policy with our soon-to-be former Prime Minister's advisors. And the regulators are not independent. I hope there aren't any in the room, but they truly are not. There is an ideological opposition to regulated utility businesses earning enough of a return on their capital to be able to grow their dividends. And as a result, we don't own, and we have very little exposure, but we find the UK to be almost uninvestable when it comes to regulated utilities. We feel far more welcome and rewarded in other jurisdictions, primarily in North America, where regulators say, yeah, the infrastructure needs bettering. We need your capital. We'll incentivize you to invest your capital. We'll allow you to earn a decent return on that capital on behalf of your stakeholders so that you can grow your dividends. It's a very simple concept, but it's not one that's adopted here in the UK. Sadly. Perhaps that will change, but it won't be under Jeremy Corbyn. Now, all of that is without Jeremy Corbyn. Now, if you do get nationalization, I think all bets are off. Perhaps you get compensated eventually. Perhaps it's through the international courts. But in the meantime, your equity values have been destroyed. And so we are quite wary of that. It's kind of uninvestable anyway. If you add Jeremy Corbyn to the mix, it kind of throws the whole argument out the window. We actually have a small exposure to National Grid, and I joke with my team, it's a half a position, and the half that we own is representing the half of their business, which is in the United States, where they earn a fair return and where most of their capital investment is going. And this kind of speaks to, sorry for the diatribe, but it starts to speak to some of the long-term issues we face in this country from this kind of public policy. Because if you're not incentivizing capital spend on networks, on infrastructure, it's not going to get done, and we're all going to lose out in the future, especially when it comes to things like electric vehicles. And we've all seen the headlines on the cost of reducing our carbon footprint in the UK, and infrastructure is a big part of it. So, duration. Okay. In the 27 seconds that I have left, I will quickly say that yes, these are long life cash flow streams. Yes, from time to time, they can be made volatile in the way of equity values by interest rate volatility. But over the long term, I'm actually agnostic to interest rates. And the reason for that is because we're investing in businesses with growth characteristics. And if interest rates are going up further out the curve, let's say 10-year, 30-year interest rates, one would hope that it's reflecting growth characteristics and inflation characteristics in the respective economies. And we love growth and we love inflation in this asset class because that's what we're exposing ourselves to. If we were just buying high yield, no growth utility businesses, we would be hydration. We would be interest sensitive. But over the long term, we aren't. That said, we get these wonderful opportunities when interest volatility arises. I'll leave you with a quick statistic. Apparently, I have 35 seconds left. Oh no, I'm over 35. On the days of the highest bond market volatility in the United States of America, as much as 2/3 of the trading in interest-sensitive stocks, utilities and real estate stocks, is done by algorithms. Robots are trading these stocks. And we love that because we can take advantage of those opportunities. And we have done it, and we've been rewarded for it. So I think that's all the questions, if I'm not mistaken. Thank you so much for indulging me and the history lesson and all that stuff. I really appreciate it, and thanks for your interest and your questions. Thank you.